Hello friends, very good evening. In this edition, we'll be discussing about how to record the journal entries. So all of you must have heard about what is a journal entry. Journal entry is a basic record of financial transactions, how it appears in the order in which the financial transactions have taken place. In our previous video, we discussed about the debits and credits, how to record debits and credits based on the basic accounting equation of assets are equal to liabilities plus equity. In this video, we are going to discuss as to what exactly is a journal entry, and we will resolve all our questions as to what is a debit, what is a credit, and how to record or identify the asset or a liability or an income or expense depending on what this transaction mean to us. And it will be very easy for us to understand how a journal entry is recorded. For example, what is a journal entry? A journal is a record of financial transactions in the chronological order in which it appeared. So it appears in the chronological order in which the journal entry takes place or the financial transaction takes place. For example, the financial transaction has started on 1st of January. So then the first journal entry would be on 1st of January. If there are several transactions on the same day, then we are going to record it in the same order in which they have occurred over a day or over a month or a quarter or a year and so on. So basically, a journal is a financial transaction. A journal is a record of financial transaction. A journal entry is to record that financial transactions so that we have a record of all the financial transactions that the business has incurred over a period of time. So a journal entry, as you see, is a record of all financial transactions. Now, what exactly is a journal entry? So it's a record of financial transactions. What does it contain? It contains date, it contains title of the account, it contains the amount, and it contains the reference number, and there is a brief description of the transactions. To give you an insight as to what exactly is or how does it look like, you can see here there is the date. Okay, there is a date. That a date is April 14. That means the business has incurred or recorded a financial transaction that happened on April 14th. So for example, here you see there is date, detail. Detail means the title of the account, and account reference, debit and credit. So what is the detail of the account? Bank account. And reference number is this number belongs to the bank loan. Bank loan is J001 and bank account number is J290. So you may ask me why this is recorded in the reverse manner. For example, when we discuss about the T accounts, there or in the ledger, we'll have to see if you are looking at a bank loan, then you will record, you will see that J290 belongs to bank account. That means how you received this amount of 7,000 of bank loan? You received it by way of cash to your bank account. So that is the account reference. Then there is a debit and there is a credit. So as you know, each transaction has got one debit and one credit. So for this, bank account is debited. That means we have received cash, and we have created a liability. That means we have borrowed from the bank. This is just an example for you to understand or how does a journal look like. Moving forward, we will see how exactly we are going to record the transactions. So here the description is given here: loan drawn down from INT bank. That means the business has borrowed $7,000 from INT bank. That's why you got $7,000 in your bank account, and you are incurring a liability of 7,000 which you have to pay to your bank. So that is, it is just an example as to how it looks like. Now moving on, here are some of the transactions that happens or happened in a business during the month of January. So what are these transactions? Let us see here. So first one is John is a sole proprietor having a provision store. Following are the transactions during the month of January 2025. Journalize these transactions in a general journal. General journal means it's a ledger. It's a book that contains all the financial records. of the business. So you see the date is given, the transaction details are given, amount is given. This is how a business records or records all the transactions that has happened, which will be transferred to a general journal by way of a journal entry. So what is a journal entry? We will see. For example, each account we will see. In the first case, they commenced business with cash. That means what is happening here? The business has received cash, right? The business has received cash. Who has deposited this cash into the business? It is Mr. John. So now we have to record. All there are 9 transactions here that has happened. So let us see how we record this, each of these transactions in the next slide. Okay. See, the beginning with cash. Okay. First one is January 1st, commenced business with cash. So business has received cash, right? And cash is an asset. Business has received cash and cash is an asset. So when business receives cash, the cash account or the asset account increases. So remember in the previous video, we discussed that debits or those for assets, always they have debit balances. To increase an asset, we debit it. So we have debited cash account because it's an asset. So debit cash. And what is the other entry? Nothing is mentioned here. So here we have to assume that Mr. John has deposited this $80,000. So that means the business owes this amount to Mr. John, who is the proprietor. So we have to credit to his capital account or equity. Remember the equation, basic equation, assets are equal to liabilities plus equity. So here the business has credited Mr. John's capital account by $80,000. So this is the first one. So we have the date here. Account title is cash for debit, and the chart that is account number for cash is 101. Sorry, 101. And John's capital account, the number for this is 102. So in the reference you can see it is backwards. That means against cash we have recorded 102, meaning that when you refer to a cash account in your book, you know that 102 belongs to Mr. John's capital account. And when you refer to John's capital account, it is recorded as 101 under reference. That means it belongs to cash. That means John has deposited cash into the business. So the debits and credits should always match. So this is simplest of simple transactions, where you remember that business is a distinct entity from that of an owner, right? Business and owner are separate. Although John is the owner, proprietor, but the books of account of the business is maintained separately. So John's account is credited and cash account is debited because it is an asset, right? Very good. So now let us look at the second transaction. Okay. Second transaction, deposited cash with the bank. Now what happened? The business is opening a bank account because it has received cash. It cannot keep so much of cash with it. So it went to the bank and it deposited $40,000. So here what is happening? We are depositing with the bank. That means bank account, it is an asset. Any balance with the bank is an asset, right? Cash, just like cash we are having, cash is with the bank. So that is an asset. So bank account, our balance is increasing. So we are debiting the bank $40,000. And since cash is going out, we are crediting that because cash is an asset, cash is decreasing. You received $80,000 in the first instance. In the second instance, what is happening? Of this $80,000, you have deposited $40,000 into the bank. So that means that is an asset for us. The bank deposit is an asset for us. So we have to debit the bank to increase the asset amount. And since cash is going out, cash is also an asset. To decrease an asset, we credit it. So debit bank, credit cash account. Again, reference cash account, as you saw in the previous video, it was 101, right? So similarly here we are going to record that 101 against bank account, meaning that it belongs to cash. And in cash account, we are mentioning 103 means this amount is deposited with the bank because bank account number is 103. So that is how the reference numbers are given, right? So when we actually work on the T accounts, we'll know how these numbers are reflected in the T accounts, right? Now, next one is, okay, next one is, yeah, purchased goods by paying cash $5,000. Now, what's happening here? The business has purchased goods or inventory. So, inventory is an asset. And how did we purchase that? We purchased that by paying cash, right? So, again, cash is decreasing. So, credit cash because cash is an asset. When it decreases, when asset decreases, we credit it. And merchandise inventory is an asset. So merchandise inventory is coming in. That means inventory value will go up, asset value will go up. So debit it. Debit when you receive an asset, credit when you lose an asset, right? Or when the asset decreases. So debit inventory for 3rd January, $5,000 and credit cash. Again, cash account 101. Reference is given against merchandise inventory. Merchant inventory is 101. It's account title number. So that's reflected under the reference for cash. That means if you see cash account 104 means immediately you know that you paid $5,000 for merchandise inventory. That is how it is recorded. Now going to the fourth one. Okay, the fourth one, purchased goods for, sorry, yeah, purchased goods from Lipton and Company on credit, $10,000. That means what happened here? We purchased again merchandise inventory, but this time we did not pay cash. What happened? How did we get? Because we borrowed, we got it on credit, accounts payable means we promise them to pay at a later date. So accounts payable is the title of the account. That means these are the suppliers to whom the business owes money. Since it is a liability, to increase the liability balance, we credit it. To decrease the liability, we debit it. So you know that rules of debits and credits. So merchandise inventory being an asset, we got merchandise inventory. So to debit, to increase that, we debit it. And accounts payable is a liability. To increase the liability, we credit it. Clear, friends? So we purchased inventory. Inventory comes into the business. It is an asset. To increase the asset, debit it. Accounts payable is a liability because we purchased it on credit. Credit means we borrowed. We promise them to pay later on. So till we pay, it is a liability. So it's titled as accounts payable. It's accounts payable 10,000, right? Perfect. Now next is sold goods to Joy and received cash 10,000, 11,000. That means the business has now started growing. So we not only purchase goods, but we also sell it. So goods valued at $11,000 has been sold and we received cash. So when you are receiving cash, what we will do? We will debit it because cash is an asset. Cash is coming inside. So to increase an asset, to increase cash, we debit it. Always remember, to increase an asset, we debit it. To decrease an asset, we credit it. So cash account is debited. Now sales revenue, it's an income. So remember, all incomes are credited, all expenses are debited. So when we sell goods, we get revenue. So revenue is credited and cash, we received cash. So that account is debited. So debit cash and credit sales revenue, right? Perfect. Now let's go to the sixth one. Okay. Paid salaries by cash. That means what happened here? The sixth transaction is we paid salaries. Salaries is an expense, right? So debit salaries expense. Remember, incomes are credited, expenses are debited. So debit salaries expense. And since we are paying it by cash, Cash is an asset, cash is going out, cash is decreasing. So to decrease an asset, we credit it. To increase an asset, we debit it. To decrease an asset, we credit it. Expenses are debited, incomes are credited. So that's why salaries expense is debited and cash is going out. It's an asset. To decrease the asset, we credit it. Perfect. Okay, next. Paid Lipton and Company by check for the purchases made on 4th of January. So what happened here? We purchased, remember the fourth transaction where we purchased $10,000 worth of goods. Let me show you that. Okay. See, fourth transaction here, purchased goods from Lipton and Company on credit. Now we are recording the transaction number 7. Paid Lipton and Company by check for the purchases made on 4th of January. So what happened here? On 4th of January, we made the payment of $10,000. So that's what we are going to record here. So the 7th transaction is what is happening? Cash is going out now, right? So when cash goes out, or how did we make the payment? We did not make payment of cash, but we issued a check. That means our bank will debit our account. Our bank will recover this amount from us. So we have to debit accounts payable to decrease the liability and credit bank account because our balance in the bank will decrease. So if you are paying cash, we are crediting cash. If you are paying through bank, we are crediting bank account. So bank will reduce our money in their account. So our bank balance will get reduced, right? So accounts payable debit because to record the decrease in the liability, we debit. To record increase in the liability, we credit it. So accounts payable debit and bank will be credited. Next one, bought furniture by cash. What happened here? What's happening? Yes, cash is going out, right? When you are purchasing something, you are paying something. So when you are purchasing something, what is coming in? Furniture is coming in. So when furniture comes in, furniture is an asset. So asset balance goes up. So which account we debit? To increase an asset, we debit it. So furniture account is debited and cash account is credited. Why are we crediting cash account? Because we are paying cash and cash is an asset. To record decrease in an asset, to record decrease of cash, we credit it. So always remember, to increase an asset, we debit it. To decrease an asset, we credit it. Opposite happens for liabilities. To increase liability, we credit it. To decrease a liability, we debit it. To increase an expense, we debit it. To decrease an asset expense, we credit it. Similarly, to record income, we credit it. And if there is a reduction in income, we debit it. Okay. Now coming to the last one, paid electricity charges by cash. So what happened on 9th of January? The business incurred electricity charges, that is $1,000. Electricity bill is paid. So that means it is an expense. So record an expense, we debit it. And how are we recording it? We are making payment of cash, right? So cash is going out. So to decrease a cash or an asset, we credit it. So as simple as that, friends. So again, just let me recap what we discussed. Journal entry. Journal means record. Journal entries means record of financial transactions in accounting. So what are the columns in a journal entry? You see that there is a debit, date, account title, reference, debit and credit. What is the purpose of reference? Just when you are recording it in a T account or a ledger account, we will immediately recognize that expenses of 110 is paid through cash. So in cash account, 110 is recorded reflecting electricity expenses account number. And in electricity account expenses account, 101 is recorded to indicate that electricity charges have been paid in cash. So that is how the journal entries are recorded. Hope you understood everything, my dear friends. Thank you very much. So this is a summary of what we recorded for all the 9 transactions. And I hope to catch up with you very soon with adjusting entries. Okay, we have seen so far what is a journal entry. The next step will be adjusting entries at the end of the month, quarter, half year, or year, as the business would like to recognize their income on a monthly basis or on a quarterly basis. So there are certain adjusting entries to be done that we'll be discussing. So what are these adjusting entries? There are different types of entries. One is a transaction entry, which we saw just now. Adjusting entry is for the month or quarter or year end. Then closing entries are to make the income and expense accounts zero at the end of the month or quarter. Compound entry is there may be one debit and multiple credits, or there may be one credit and multiple debit entries for the transactions that we'll be discussing there. And reversing entry. So when what is reversing entry? When we recorded something wrong, so we have to reverse that entry to account it properly. So basically that's all for the journal entries today. Hope you enjoyed my session, and please do give your comments in the comment section below, so that I would be able to reach out to you and clarify any of your questions. And it's been a pleasure talking to you. Thank you so much and have a wonderful evening. Bye bye.